welcome everyone to DigiFest South 2014. The panel that you have before you is on the subject of investing in startups. And we have with us today a set of luminaries that are very active and very experienced in the arena of startup funding and investing, particularly at the startup level and at the small business level. So I know each of you personally, and I could basically verbatim recite the exact same introduction that you've had at events around Shreveport in the last couple of months, perhaps the last couple of years. And so instead of that, I'm going to just give each of you the opportunity to tell us who you are in your own words, as opposed to listening to me tell you who you are. So if we can start here with Mike Smith, and we'll just go around. Tell us who you are, what your area of expertise is, and what you hope to be able to accomplish in this discussion today.
Okay, my name's Mike Smith. I'm from Little Rock, Arkansas. By way of background, post-education investment banker. As that relates to investing, our investment banking firm was also a merchant banking firm, so we made investments in some of the companies that we did work with. After that, I've been an advisor to startup companies through our program in Arkansas called Innovate Arkansas, and I think it's at least several hundred startups that we've evaluated over the years. And as it relates to investing in those, we help prepare, among other things, help prepare some of those companies for investment dollars. And also, along with Jeff and some others, we founded a member-managed angel fund, and we've been actively investing in on our third and fourth funds, angel funds in Arkansas. In terms of what to accomplish today, I don't know. I hope we can satisfactorily answer any misconceptions or questions or things like that you might have about startup investing.
Perfect. Wonderful. Thank you. Brett?
Hey, thanks for having me, Anton. So I'm the Director of Operations at Startup Junkie. I support Mike and Jeff with the management of Gravity Ventures Arkansas Fund 1 and 2. Jeff and I run Natural State Angel Association out of Arkansas, and I'm an investor and the director of operations for the Tonic Fund out of Arkansas too. So we, through Innovate Arkansas and through those outlets, we probably see 700 to 1,000 entrepreneurs at all stages raising money, and we get to see all different types of ventures, and it's been a great learning experience, and so hopefully I can help provide some kind of insight today.
Outstanding. Thank you. Jay?
Jay Amargos, Startup Junkie Consulting out of Fayetteville, Arkansas. My background is commercial banker, also organizational development. So I was able to work in commercial lending for many years at a bank based out of Arkansas. And also in organizational development, but also I had a recent experience with a startup. So I was able to sit on the other side of the table and know what it feels like to look for what investors are looking for. So hopefully I could bring a little bit of insight and value to our audience today, what to look for.
Very good. And Jeff?
Anton, thanks for having us. This is a great forum. We're glad to be here. So my name is Jeff Amrine. I'm the director of University of Arkansas Technology Ventures. I'm an advisor at Innovate Arkansas. I work with Windwalk International, kind of on a national basis, looking for startup ecosystems, involved in 5 early stage funds, and do some representation work for venture capital firms as well. So all told, I think of more than 50 early stage investments in the past 5 years or so. A lot of experience in looking at management teams and trying to assess good opportunities. And hopefully we can talk about some of the do's and don'ts and the things that we see that work and the things that don't work as well during the course of the conversation. Glad to be here.
Can I say something about Jeff?
Please.
Well?
Yeah.
So he missed a part that I think is important. if you're an entrepreneur, you can also relate to Jeff maybe in a better way than you can maybe the rest of us, because he's been a part of several startup companies that have been funded, so he can look at the situations from both angles as the entrepreneur and the investor at this point.
Outstanding. No, that's an excellent point, and I'm glad you raised that. We had a brief pre-meeting before we got here to the stage, and I just wanted to give them a bit of insight on some of the discussion topics that I thought would be most useful for our viewers and everybody on the internet that's going to be seeing this. As I said, this forum and this discussion is going to live in perpetuity on the internet. And so all this content you're sharing now is evergreen and will be associated with you forever. So make sure that you say substantive things that you may not want to back up on later on. But one of the topics that I think is really something that we need better education on is, what is it that you as investment professionals, as angel investors, as fund managers, as VCs, what do you need to see from a founder or from a startup with respect to their value in determining whether or not there's something you're going to actually invest money in? I know that people approach you all the time, and you see hundreds, if not thousands, of deals a year, and some are very easy to vet and say no thank you and walk away from. Some look good on the surface, and you have to do more due diligence. Tell us what it is that small businesses and founders and startups need to come with when they approach you. Where do they start, and what do they need to evolve to make them interesting to you?
You want to start, Mike?
I'll start. I'll just pick up. I mean, I think I could summarize that question as what's an investable deal look like, or investable entity. That's hard because there's a lot of facets to that. But the one I'll always like to point out is it's mostly about people and the founders and their abilities. You can have a second-rate idea, a third-rate product, but if you've got a first-rate person, that can
team, yeah.
and team, that's right, that can easily overcome being second or third-rate in terms of product or idea. So then you might ask, well, what is that team or that person like? And that also has different components to it too. Everything from domain expertise in the area where they truly have lived and understand the problem they're trying to address. That can be an important piece. An ability to execute and a track record of having executed before. That's a lot of times that's number one. But those types of things, it's people first. And I'll stop there because I don't want to talk the whole time.
That's quite all right.
Yeah.
Brett, tell us, what is prepared versus unprepared look like to you?
Well, I guess adding to what Mike said, I think what I really look for, and I think being prepared is, I guess, a virtue of this. If you've got some kind of unfair advantage, some kind of secret sauce or competitive moat, and a foreseeable exit, then that's something that really stands out to me as, a prepared or a deal that will more likely get investment, because it's an investor's market right now. We see so many deals, and if you've got revenue, you've proven that you're solving a pain point, and it looks like it's scalable, and there's a foreseeable exit, then that's a deal that's more likely to get funded. And if you've got a good pitch deck and you've met with people like Mike and Jeff who see a ton of these things, then that always helps too.
For me, I think it comes down to two things: capacity and credibility. So do you have the capacity to take care of what you say you're going to take care of? Do you have the ability? And then, credibility. Have you done your market research? Do you understand who your competitors are? So do you have those two things? You know, if you're not able to maybe execute, do you have the right people around you that are going to help you do that? So that means your capacity. And then, you know, credibility. Have you done your homework? Have you done your research? So when you come prepared to talk to us, do you really understand your product, your market? I think it's important. If you come to talk to an investor and you really do not understand, you know, your market, who your competitors are, then, you know, you're really not credible. How can we trust you and believe, you know, what you're offering and bringing to the table?
Understood.
There's
Yep.
there's an advantage to going last in these kind of conversations.
Absolutely.
These are all these comments are right on. There's no controversy in any of that. The other things that I would say is an element of coachability. You know, it's rare unless you've done it 5 or 6 or 7 times, and even if you have, if you come into any situation knowing 100% of what you need to know. And early stage investors, the good ones, bring with them a fair amount of subject matter expertise. And they tend to not just want to be financial investors. They want to be helpful in terms of mentoring and supplying some guidance. And they're really looking for people that won't necessarily just take everything they say verbatim and go do it, but that they can have engaging conversations with. And also people that when they're challenged will respond to that challenge in the right kind of way. They won't respond to it with emotion. So I think that we're all boiling back to the same thing. It's team. It's a great team in an interesting market that looks to be of large enough size that it's worth pursuing. And there's at least a reasonable belief that they can carve out some kind of a competitive advantage, either through an intellectual property or ability to out-execute or unique relationships with customers. And then fundamentally beyond all that, it's what evidence do they have to support their assertions. So the best evidence is customer traction. They've solved a problem that someone would pay to have solved. It's a meaningful enough problem that they've got customers that are willing to pay. A lot of the rest of it is no one these days in this geography or any that we're operating in is investing in ideas that don't have validation. It's got to be a business model that at least has some proof or evidence that it's going to go somewhere.
So to that point, let's expound off of that, and then we're going to come back the other direction. That way you have to go first and Mike goes last.
Sure.
From what I've heard, it seems as if having a grade A team is at least as important, if not more important, than having a great product. You could have a B or C product, but as long as you have a grade A team, that means you are more likely to gain the investment that you were looking for. And then you mentioned the unfair and competitive advantages you have. Can you out execute? Are you better at marketing by demonstrating that you actually have user adoption?
Yeah.
Those things also seem to be somewhat separate from the quality of the product.
Yeah.
So if you are an investor, what's the hierarchy that you use to determine what's most important to you with respect to great team, ability to execute, unfair advantages, and then product? Or does product come number 2? Or is it all case by case? Or do you have a system that you can use to determine kind of a plug and play equation that you can use?
Now, there are people that will try to come up with scoring systems to evaluate the probability of success or failure, but fundamentally it goes down to the judgment of having seen a lot of deal flow.
Sure.
And having some pretty strong understanding of the market segment that the company is trying to address. Or if we don't know something about that market segment, we'll find the people that do, and we'll ask them the hard questions as well. But it starts with the people. It really does start with the people. We've made investments in the past in teams that we had high confidence in because we knew they were going to be capitally efficient, because we knew they were very bright, because we knew they were going to be tenacious and they were going to work very hard. Even if we had some question about the way the industry segment they were going after or the focus they had initially, there's been at least 2 or 3 examples that come right off the top of my head where the company is in a completely different industry segment than where they were when they started.
Sure.
The product was fundamentally sound. The marketing direction changed in dramatic ways. So you invest in the team first, and if it's a really good team, you know that they'll ultimately figure it out. They'll figure out what direction they should go, maybe with a little coaching and maybe not.
I say team first. I've personally seen the case where the product has been an amazing product where it's just one of its kind, but the team wasn't functional. So the product just didn't get out there because the team didn't have the capacity or the culture or the ability to get it out there. So it fails. So definitely the team is to me the most important. It just got to be the team, because they will make they can either break it or make it. If you have the team, they will have the ability to do all kinds of things, and they will get the product out there. They will take care of the marketplace. They will take care of the client. So the team has to be first.
So, Brett, something you mentioned is that you are always on the lookout for a solid exit strategy, because that is, one of the markers to guarantee you're actually going to get the return that you're looking for in your investment. If they can execute and the exit strategy makes sense and it looks viable, then that makes them very attractive. What do you do when you have a team of very bright people that can produce great stuff? They clearly have the talent, they clearly can provide value, but perhaps the marketplace shifts under their feet, or their exit strategy is a half day behind because somebody else beats them to the punch. What do you do in that scenario? How do you reevaluate or change the equation when you have a situation like that come up?
I think the right leadership team will be able to adjust to a change in the market, and I think the right investors, the right strategic investors, would be totally understanding of that, because there's some things that founders just can't control. And so if you pick the right strategic investors, and then they're going to be on board with you. So and there's no way of projecting, when you're going to have an exit, when a company's going to come in and acquire you, when a bigger VC is going to come in and clean up your cap table. There's no way of really projecting that. But if it takes 7 years or 10 years instead of 5 years, I don't think any investor is going to be upset about that. So.
What did you mean by the term strategic investor? What do you mean strategic?
So if you were running a specialized clothing, Southern preppy lifestyle e-commerce company, you would want to find maybe the CEO of Tommy Bahama or somebody in Amazon who's an executive to come in and invest in you, because you're not just taking their money, but you're also using them to open doors and to provide expertise, and that's just as valuable.
And let me tag on to that.
Please.
That's a bit of advice from the startup side. Is that the money of last resort is a straight financial investor that's adding no other value. Find somebody that can help make it rain, that can open doors, that can help you solve problems. That money is worth a whole lot more, and is going to help really build that value and reduce risk in the business. We've seen that time and time again.
No, I certainly appreciate that. Mike, when we had our brief pre-meeting, I mentioned something that a founder of a very prominent West Coast incubator once said to me. He said that when it comes to in particular or potential investors, the one thing that they don't want to see in a founder or in a small business that's approaching them is weirdness. His rule is first, be not weird. And I think he was making distinction between having some idiosyncrasies and, maybe being an interesting guy, quote unquote, or an interesting young woman, quote unquote. But if you're weird, if you're weirding the check writer out, there's less of a question that you're going to get that check. And you said, you kind of thought about that and said, well, I might disagree with that and go the opposite direction. What did you mean there?
Yeah, I think.
What's attractive about weirdness that would make you open your pocketbook?
Yeah. But you already kind of hit on it. There's gradients of weird, I guess, and some idiosyncrasies are not a bad thing. In fact, a very successful investor at the investment banking firm where I used to work used to say he liked to invest with a founder who's got an eye tick. Okay, he's doing this all the time, and you said, well, what's up with that? Well, he felt like there's a intensity and nervousness that causes that he wants to tap into.
Yeah, there could be high blood pressure too. He's about to have a stroke. I don't know if you want to invest in that.
Yeah. So, but I think the point is, those kind of things may. Now, I think what you're talking about on the weird side, I'd agree with, is the founder that you can't get to the trust level where you want to pull your wallet out because you just don't feel like there's enough truth, there's enough execution. Weirdness kind of overcomes all that.
Gut sense of squirreliness with that. Yeah.
That's the way I would answer it.
Well, how often have you seen that? How many times have you seen in your career where you thought somebody had a halfway decent idea that may be worth your time, and then you meet the guy and you run for the hills? How,
a lot. I mean, that happens a lot. But on the other hand, I think another thing we were talking about was there's the passionate entrepreneur. There's something to that you could call on the weird side. I mean, you're passionate. You do not want to give up, and if there's some weirdness to that, so be it. And maybe you can't, as an investor, you can't get fully behind that person, but he's got a team. If he's got a team with him, and he's the evangelist, and he's got a board or investors that can sort of round him out, and his team can help round him out and be if that person you just can't, you don't think he's the guy that can execute, but he can come up with all the wild wild ideas that can be vetted and massaged. Then you can invest in the team, and so again, maybe weird is good in that scenario if those things can be managed, if that makes sense.
Yeah, absolutely. Anyone else with thoughts on strangeness you've encountered?
Yeah, I mean, I think if you can channel the creativity, entrepreneurship is an inherently creative business.
Sure.
So if you can channel the creativity, one of the good sort of a litmus test for that is you can be as weird as you want, but can you hit milestones? Are you going to honor your commitments? Have you got a team rallied around you that's going to fill in the places where you have weaknesses? Has any of that weirdness kept you from getting customers to be delighted by the solution you're selling? If all those things are kind of like, yeah, they've got this figured out and it's kind of a character, that's fine. The thing that I typically don't like to see and would not invest in is hubris, is progressive disclosure, is a lack of humility, is a thinking you know it all. If it's a contest between the investor and the founder to prove who's the smartest person in the room, the founder might win that, and they may win that battle, but they will lose the war because people are typically not going to invest in that. And those people are also the ones that typically run 1,000 miles an hour into a brick wall thinking that they got it all figured out. So.
Excellent point. And I'm guessing everybody else has basically had their thoughts shared. Don't want to touch on the weirdness, and I don't blame you. Jay, something you mentioned earlier, you need to see that founders and potential small business owners looking for investment have done their homework. And we talked about in our pre-meeting whether or not investors are still looking for the big 100-page business plan with the 5-year projections and a big Excel document with pro forma information. And the general consensus is no, don't need to do that. You don't even need to do that as a qualifying step just to prove that you know what you're doing, which is, argument I've heard previously. What is it that you need to see? What does the homework need to consist of? Particularly if you have somebody who is a subject matter expert, but they're not technical or they don't have a business background and they're intimidated by doing their own market research, and they're intimidated by doing, their own lay of the landscape. What can you tell those people to do to be most prepared when they may feel intimidated by that process? What can they do to make sure that they're prepared when they approach?
Sure. Yeah. Typically, you leave that for the bankers, right? Your big business plans. That's not something your investor want to see, but and Brett can help me with this too, because we see hundreds of decks each year at Startup Junkie, but you basically want to show your team. You want to show what the problem is. How are you going to solve it? Who's your competitors, your numbers, to make sure that you've done your homework, how you're going to use your usage of your capital, how are you going to use your investment. Those are the main things that your investor want to see. There's no need to do 5-year projections or any of that unnecessary information that you only say for your bankers. But those are the basic information that we want to see when we meet with you in the beginning, just to make sure that you've done your initial homework. We want to understand who your team is, the type of experience that you're bringing to the table. What's the problem? What's the solution that you're bringing to the market?
Brett,
Want to
you
add
agree?
to that, Brett?
Particularly, again, adding on to this, your point about needing to see what the exit strategy consists of. And again, that could be something that's very
That's
intimidating
big.
for a first-time
Yeah.
founder. They may not have any idea as to how to successfully execute an exit, how to position themselves for a potential acquisition or sale of their company or their assets. So at that first or that second meeting, what do you need to see from them that constitutes homework?
So I guess really practically what we look for and what Tech Operators looks for, a huge VC out of Atlanta that we work for, with what Fulcrum Equity Partners, another big VC, and Nora Mosley, another big VC that Mike looks for, I think, is really you're looking for a short executive summary, 1 to 3 pages, and you're looking for a pitch deck, and then you'll usually have a call with the VC if you're the company or the angel investor, and you're going to go through what you have accomplished and what you're looking to accomplish and how much money you're looking to raise and what valuation you're looking to raise that money at, or what type of deal structure you're looking at. And the whole idea is, if you're looking to raise $500,000, you need to use that $500,000 that's going to take you to, you're going to accomplish certain milestones with that money that's going to take you closer to an exit. You're going to increase your revenue from $1 million to $5 million. You're going to grow your market share. You're going to become more profitable. And it's pretty practical. I'd say it's pretty standardized. Everybody's going to look for different things, but I think it's
Can I
pretty
add to
standardized.
that?
Please, absolutely, Mike.
So maybe on the exit, it's in our in the pitch outline that we hand to founders to work off of. The exit slide is the last one, and a lot of founders, to your point, are saying, well, what do I need to say there? And some of them will say, some of the founders will say, oh, well, I want to go public, and oh, whoa, don't say that. What we coach the founders to think about is know your market well enough to understand at what point in the development of your company are you going to be attractive to someone else, and why. And if they understand that, then you can start to develop a story that leads to an exit. And what we'll do is just talk through those issues, and it's guesswork, just like the 5-year financial plan is guesswork to some degree, but it's educated guesswork. It's understanding who in the marketplace would want to own your company, added on to what they're doing for what reason, and we like to help them, lay that out at the end of the slide deck. And who knows what's really going to happen? Sure. But an educated thought about that is what investors would like to see you spend time on, and that involves it does involve some research into your competitors and those names and categories that make the most sense to be acquirers. A lot of times you don't have to look too much further than just the partners that you'd want to partner with. Many times as a company, the people that you'd want to partner with are probably the ones that will want to buy you if that relationship goes well.
No, excellent point. Jeff, a question that I want you to start with. There's a lot of terminology that's tossed around that is popular, but I don't know that a lot of the founders, would-be founders or would-be small business owners really have a full appreciation of what those terms actually mean, at least outside of the major poles of the East Coast and Silicon Valley. I want you to think about and answer this question with respect to what a potential investor, an angel, or VC may want to do and how they consider themselves a part of this process. You have a business idea. You quit your job, you raise a friends and family round, and then you raise a seed round, and then maybe you go back to your grandmother and get another, a seed and a half round. And then you talk to some angels, so you can raise an angel round, and then you scale, and then you're talking about a Series A and then a Series B, and then somewhere in there you think about going public, and then you're a billionaire.
It's just that easy.
Exactly. People have some familiarity with that terminology,
Sure.
but they don't know what the steps actually consist of, and they don't know how to prepare themselves to get to an A round, and what they have to go through in order to be in a position to be that attractive. So start us off from that friends and family round and tell us what each step in the process consists of as you matriculate.
Yeah, sure. That's fine. And it can vary, but I think you actually outlined it pretty well there. Typically, there's not a lot of investment in ideas that don't have any validation. So the first thing is you're working out of your own wallet. You're bootstrapping. Yep. And then you go to those people that love you and are too naive to not give you money, and that's the friends and family, as you described. And the whole idea here, your fundamental function as a startup founder is two things. You're a problem solver and you're a risk manager. So you try to add value by reducing the problems that you see and actually solving a problem that someone would pay for. And you figure out what are the priority risks that have a high probability chance of killing this venture along the way. As you change that risk profile, your ability to raise increasingly large amounts of money as you grow the company increases. Now, there's great books written on this, but the other thing is you have to not only be a student of your market, a student of your product, and great at building a team, you need to be a student of the language that goes along with being a venture or angel-backed founder. There's books like Venture Deals written by Brad Feld that you ought to carry it around like a Bible. You ought to be reading Fred Wilson's ABC blog posts. You ought to be reading all the stuff that Paul Graham writes. Now, some of that is biased to the coast, but read everything. You have to be a voracious consumer of information on the mechanics of how to raise money. How do you get prepared for that is you're providing increasing amounts of evidence at each step that it's a lower risk proposition for the next round of investor. And you're beginning to build the documentation that goes along with the due diligence pack, because a venture capital firm will take you through an industrial psych exam. They'll talk to everybody you've known for the last however many years. It's a very comprehensive process. So you need to have that stack of all the corporate documents, all the references, begin building that early on. And it's progressively going to get bigger along the way. But it's a progression from the out of your own wallet, friends and family, seed, angel round, Series A when you get to it, and the sort of startling prospect of actually getting VC money, which is not a requirement to build a great business, is that only 0.3%, 3 out of 1,000 statistically can actually raise VC money. It's easier to get into Harvard than it is to raise VC money. So you can't, it's not a life or death situation, but you improve your odds by removing that risk and building the case for why you're a better investment as time goes on. And become a student of how all that works. You have to know as much as the people on the other side of the table to make it through the process.
And as it relates to that's generally as it relates to risk.
Right.
But there's maybe some generalizations you could make about the development of the company in terms of being pre or idea, then pre-revenue, post-revenue, beyond. You're certainly pre-revenue at that friends and family, probably at sort of a validation stage. Sure. You might be pre-revenue or slightly post-revenue in an angel round, you're starting to show some things that give someone that you don't already know, a third party like an angel, some comfort that they could step out and help you. And then certainly the VC round is most typically a post-revenue phenomenon, and that varies. But the ones the common ones that we work with that look inside the coasts are looking at around $1 million of revenue, where it's not just or close to $1 million of revenue as sort of as a baseline or a starting point. And not just revenue, but revenue that is where you figured out some of the issues around that revenue, and you've got something that you can replicate and probably scale. So it doesn't look like it needs a whole lot of work. So that may be helpful as well in terms of progression.
I have a question for you, and I always ask this question of anybody that's involved in investing in finance. When was the last quarter that Amazon turned a profit?
I think they're still
Is that
burning all of it.
trick?
I mean, it's very, very low margin.
Well, yeah,
That's
Amazon has never turned a profit.
Right.
Amazon sold their first book in 1995.
Sure.
They've never had a quarter. They've never had a profitable quarter.
Sure.
I knew it was low margin, but not no margin. Yeah.
And the reason is because Amazon's play is so long term
Yeah.
that the point where they start making a profit is still another 10 years out.
Mm-hmm.
But at that point, everyone on the planet will be an Amazon customer. They will have swallowed up all the competition. The data play, which is what Amazon is really about. Amazon's never been about books, if you didn't know that. Amazon has always been about data. They own you, and they own you by selling you stuff. Whenever you can't figure out what a company's product is, you're the product. Just a word of advice. And that's Amazon's play. They know what the long-term value of everyone who buys at Amazon will be, what the lifetime value of everyone will be. And so at a certain point, they can stop building data centers, they can stop advertising. They don't have to do that anymore, because every marginal dollar in revenue that they make above a certain amount at some point in the future is going to be pure profit. And it's going to be billions upon tens upon hundreds of billions. They don't have to turn a profit yet.
Sure.
But for whatever reason, stock price keeps going up. And that's a very dangerous model for people to know a little bit about when they're trying to start their own startup endeavor. And so tell us about some of the models that you have some experience with that may be household names now, or maybe are stars in their vertical, that founders and people who are looking to start their own business should look up. Tell us where you would send us as an example.
Well, I'll start with one that we have kind of firsthand experience with, and that's Acumen Brands, which, as it turns out, is a Southern lifestyle-focused e-commerce play. And the thing to start with there, in anything that's digitally related, is you have to know the mechanics of what really drive the business. In that case, it's what are the customer acquisition costs? What sort of investments do you have to make in order to get those customers, and what methodologies do you use? And then ultimately, what's the lifetime value? How do you keep them? How do you continue to delight them? That drives the whole business. So understanding that, the mechanics of that process, and even if there's intentionality by turning it in a way that you're not intending to make any profit because you're aggressively going after customer acquisition, you measure that by how the monthly recurring revenues increase, by how the customer count increases, by a whole variety of different metrics. They are one that are worth a study. I will say that e-commerce businesses in general are becoming commoditized. The valuations are about 1.3 times market cap on average. So they have to add depth. They have to get into things like marketplaces and flash sales. They have to develop some of their own private label brands. There's a whole lot more they have to do. That's a good case study of one that's had a very good trajectory and a very smart path that they followed in terms of how they raised money and how they progressively increased valuation. A lot of times people will think they have to raise the biggest chunk of money they can at the front end at the highest valuation. It's typically a mistake. You raise the smallest amount of money that you need to raise to prove milestones that are going to add value and reduce risk, and then keep raising. 25 to 50% of your time as a startup CEO from the seed round on is going to be spent talking to people about raising money or actually raising money. As soon as you finish the seed, you're talking about the Series A. As soon as you finish the A, you're talking about the B. As soon as you finish the B, you're thinking about the C if you need one. That may be a mezzanine or a growth stage. Right. But Acumen Brands that runs Country Outfitter would be a good one to look at. Now they're a General Atlantic portfolio company. It's a $17 billion private equity firm. They invested, the public numbers were $83 million in them in 2013. And they're off to the races. But that's a good one. That's a good one to look at.
Any others?
I think when it comes to exit strategy, people need to look at Zappos, what they've done. Tony Hsieh, he was able to convince Amazon to buy them, and he maintained. He stayed as the CEO, and he was able to maintain power over the company. So I think that was a brilliant exit strategy that any startup company or company should be able to look up to. I mean, he was brilliant by selling the company. He was able to maintain power over the company and stay as the CEO of the company. So to me, that's a brilliant way to have an exit strategy.
Very good. Here's something that we should definitely address. We have about 15 minutes left, and I want to get a couple of questions from the audience. But when we did the introductions, I think everybody who's watching realized that everybody on the stage, with the exception of me, is actually out of the state of Arkansas. And I'm sure there's some questions as to why there are 4 people in the state of Arkansas continually coming down to Shreveport-Bossier, Louisiana, making yourselves known, getting to know people, and looking for opportunities here. What is it in Shreveport, Louisiana that you have found so attractive that caused you to make that 3-4 hour trip as often as you do? And what would you like to see from this area going forward as far as infrastructure support, and helping to prime the pump with respect to entrepreneurship and new business that the municipalities in this area could do? There must be something here that you see that perhaps Shreveport-Bossier itself doesn't see. So tell us about your experience in making this trip down here, and what do you see? What do you see here?
Do you want me to start?
Please.
Want me to start on that one?
Yeah.
So it's first of all, I'd say that in general, we're interested in emerging startup ecosystems. Places where there's untapped potential, places that haven't necessarily had the attention, places that maybe haven't had a history of being a tech startup hub. That's the thing that's most interesting for us. And for sure, you can be certain that we've gone from wilderness to at least a pretty good rolling level of development in Arkansas. But it was only through creating a startup movement around people that were interested in building a technology and knowledge-based economy that builds on what's already here and makes it great. And so the thing that was interesting down here is we saw some of the same things that we'd seen in the last 5 to 10 years in Arkansas. There is a pool of interesting digital talent. You have the Cohab location, so there's startup co-working. There's a level of programming associated with some of that. There's interest on the part of the economic development folks to do more of this. There's an interest in scalable businesses and in kind of reinventing the economy. You also had some interesting assets down here, like the Cyber Innovation Center and all they're doing in cyber education and cyber security. There's not a hotter area in the country. The communication discussion around STEM and around cyber and around cybersecurity is at fever pitch. So you put all that in the mixing bowl and you stir it up and you spend some time down here and you say, well, what are the gaps? And we're not coming down here to replace anything that's already here. We're not coming down here to compete with anything that's here. We're coming down here to hopefully be helpful in doing things like member managed angel funds to raise both the availability of smart capital and the smart people around the smart capital, increasing the size of that pool. It's sort of an insurgent movement that gets people into the mix that otherwise wouldn't be comfortable doing it or haven't had a long history of doing it. So we saw all those kinds of ingredients, and I think that the I-20 corridor, Shreveport in general, has a lot of really interesting attributes. Good college institutions, some motivation around building some interesting clusters, a history of being successful in oil and gas. I mean, there's lots of things that can be built upon with a sort of digital overlay of startups and other startups that build on what's here. And we want to be part of that, want to be helpful in that, and want to invest in that. So that's really why we're here.
And one other thing I would add to that is we're really kind of preaching some things that worked for us in Arkansas.
Sure.
And we didn't make those things up. We were preached to by some folks in Indiana about the angel fund that we started in Arkansas. So we didn't. We learned it from someone else, and we adapted that model to Arkansas. The Innovate Arkansas program is an adaptation of a program similar to that was successful in Oklahoma.
Okay.
So we're just trying to export some thoughts around things that are working. And since the I-20 corridor in many respects has a lot of the same, like Jeff said, similar attributes to fly over areas like we have in Little Rock and Fayetteville, we're just trying to collaborate and talk through those things, and hopefully people that are spending time with us will start to see how these things might be incorporated or adapted to this environment, and because many of them have worked for us. I think an openness to discussion and collaboration is a key component. And I'll just say one more thing on that. I mean, with this I-20 corridor, I guess mainly consisting of Monroe, Ruston, Shreveport, that area, open collaboration among because
Bossier City. Don't forget Bossier City, please.
Sorry, Shreveport, Bossier.
Thank you.
So, and that, but you need some critical mass, just
Yes.
as we did in Arkansas. We needed to come together as a state to do this, and I think North Louisiana needs to come together as a region
Sure.
to do this kind of thing.
So to that point, last question I'll pose for you, and then hopefully we'll have a couple from the audience. There in North Louisiana in the last decade or so has been a lot of wealth generated by oil and gas, particularly natural gas reserves that have been tapped on private land here. And there have been, almost like popcorn, a lot of overnight millionaires in their 40s and 50s who are young and savvy and interested in investing in tech, and they may not necessarily know where to go. Here in Northwest Louisiana, what would you say to those people that have an interest in being angels or being part of a VC fund? Do they just need to come talk to you? What do they need to do? What would you tell those people?
You want me to start that?
Go ahead.
All right. Yeah, I think that's part of it. The typical thing that happens when people have been successful in a given industry, they'll go out and try to make an investment or two on their own in something that they didn't understand or they didn't have the background on. And even if they get advice, if it's not going to be something they're completely comfortable with. And what all too often happens is they'll have a failure or two or three, and they'll never want to do it again because it's outside their comfort zone. So part of what we recommend and what we're trying to actually accomplish down here is two things. One is you get regular meetings and you build sort of an association, a network of people that can go through a process of education, learn how to do it right, learn the jargon, learn the deal structures that work, et cetera, and can learn from each other's experience. That's one thing. Up where we are, we call it Natural State Angel Association and the Arkansas Angel Network, who are two of these associations where you see highly qualified deals on kind of a monthly or every other monthly basis. The other way is you create a member-managed fund, which is not a typical general partner, limited partner VC structure where the limited partners kind of get a quarterly report and that's their only involvement. It's really a place where subject matter experts from across the spectrum of wherever they may have made their money can participate with people with completely different skills. And so when in the Tonic Fund or in the Gravity Ventures Fund, when we see a deal come in, for sure, we've got somebody amongst the membership that has been in that space, that understands how to be successful in that space and can add value. So it's a combination of investor education, providing the early stage capital, and doing it in a way that limits everyone's risk, because we're going to make better decisions by virtue of having a very diverse group. That's something that can work here as well. It's worked in Indiana, it's worked in Arkansas. It can definitely work here also.
And to your point about the oil and gas money, I'll just point to something in Arkansas that was in some ways similar. In Northwest Arkansas, it was 10, 15 years ago, the biggest retailer in the world, Walmart, had to decide a critical thing for their future. And what they decided was they wanted all of their vendors to come to have a presence right there in Bentonville, Arkansas.
Yeah.
That decision caused a huge influx of people, with large vendors putting 10, 20, 100 people in the community, and a real estate boom occurred. Mm-hmm. People that had farmland suddenly had something much more valuable, and it took their great wealth, and it took their eye off of innovation investing. Well, over time, that was massaged, and it didn't hurt that the cycle ran down, and the real estate market fell off, and you began to get the attention of some people who were risk takers, just like the oil and gas guys are risk takers, but wanted to challenge that in another direction. And so we and others were there to sort of catch that and educate that group on here's how it works to reallocate that risk capital toward venture investing. And now Northwest Arkansas has got a very vibrant angel community, and just put together the first in-state venture fund that we've ever had is out of Bentonville.
Wow.
So it can work.
Yeah, no, absolutely. That's a great story.
And that's the future we should be looking for here in the next 5 years.
Outstanding. That is very good to hear, and it's very good to know that there are people who recognize potential of Shreveport Bossier and are willing to make the time and be willing to put the investment on a personal level into this area. I want to open the floor for any questions. If anybody in the audience has any particular questions, here's your opportunity to pick the brains of some very knowledgeable people, particularly if you are a small business owner or in the marketplace to find investment. Please, here's the time to take advantage. Anyone? Here, over here. Yes, sir. There's a microphone coming right behind you.
So when you guys talk about an exit strategy, is sustainability ever one of those exit strategies, or is it always a question of getting bought out by a bigger firm and getting bought out by a bigger firm, or is there ever, and Zappos being a great example, they were fairly profitable. He's done great stuff in Vegas. Would they have been a good investment if they weren't looking down the road to get bought out by someone big, but to continue to grow as a firm?
Isn't ownership the new exit? That's what I've heard.
I think it's. I'll make a comment and then we'll share here. I think you have to have aligned interest. So for example, if you want the founders to want to build the best company they can build, and to work towards profitability, and to work towards being a dominant force in the market, and then to be open-minded about what that exit looks like. You don't necessarily, when you're an angel stage investor, want somebody that says, I'm going to do this for the next 25 years and build a $10 billion company. I mean, those opportunities, they're outliers statistically. You really want somebody that says, we're going to carve out an interesting niche in the market, and 5, 7, 10 years down the road we'll exit. Now, having said that, if somebody really thinks that they're going to build a cash flowing business, you're not playing for dividends, but there are some revenue-based investment structures that are possible that can still give a venture-like return with a capped kind of a multiple along the way that are possible. So digital media firms, for example, that are cash flowing or high margin, might not want to give up the equity but are growing really fast. That's something they could look at, and that's becoming more and more popular. And from a fund standpoint, The thing that's interesting about that is rather than waiting on this capital appreciation event when the company is sold, there's a repayment all the way along that's typically tied to the top line, tied to revenue. So there's some new revenue-based structures that aren't really debt and are not really equity that are coming to pass that will again allow for an alignment of the objectives of the investor and the founder.
Does that sort of answer the question? Okay, because the firm I used to work for, the investment banking firm, Stevens, always said they were long-term investors, and they were it's a well-capitalized family office type situation, so they could afford to be in investments for 10, 20, 30 years. If you guys are familiar with Viking Range Corporation, they were the lead investor in that company and stayed in it for, I think, well over 20 years. That points to what Jeff is saying is that alignment of interests. I think the founder in that case knew what he was getting when he took Stevens' money. In a different scenario, it might have been a fund that came in and said, we've got to have an exit within 10 years, and there needed to be some alignment of interests on that. Otherwise, you wouldn't want to change money. But that's what I keyed off of.
Outstanding. Excellent. Thank you. Any other questions? Oh, very good. Yes.
Earlier we talked about, Jeff, about consuming information, and you had mentioned some books, and I was wondering if any of y'all have other book recommendations that we should be reading as founders to make ourselves more attractive and knowledgeable when looking for investment.
The Business of Venture Capital is a great book, and Running Lean is a great book. And those two books are, if you read those, it's extremely educational, insightful, and very practical.
Yeah, Running Lean is great. Anything that's associated with the lean movement and application of scientific method to how you build your business is great. There's another book written by Jay Baer that talks about focusing on being helpful as you do your sales strategy versus focusing on selling something, and it's called Utility, spelled with a Y, Utility, written by Jay Baer. That'd be another one that ought to be mandatory reading for startups.
The Startup View is another good one.
That's Reid Hoffman, right?
Reid
By the
Hoffman.
co-founder of LinkedIn, right?
Yep.
Yeah, it's an excellent book. Yeah.
The Startup View is a great one.
And I'll overemphasize the lean startup books. I don't think I've read, and maybe I should have, but I haven't read a business plan in about a year. I've only looked at lean canvases.
Sure.
And that's becoming the new business plan, especially for a startup, but certainly for even more mature companies as well, because it's so applicable in many cases to just small iterations and testing and understanding your customer. It's not that it's all that novel. Sam Walton, his basic premise was know what the customer wants. That hasn't changed. And know what they want and get it to them, and that's part of the lean, the main premise behind the lean canvas. And it's just it's just a method that the investment community is gravitating toward. More people now are asking for your lean canvas and not your business plan or your executive summary.
Outstanding. Mike, you get the last word. Mike, Brett, Jay, and Jeff, thank you so much for being here and for giving us a great education on what it means to be an investor, what it means to be a recipient of investment when you're a startup. We do appreciate your time, and everybody in the audience and everybody watching Shreveport-Bossier, if you see these faces around town, please take the time to introduce yourselves. They're doing great work here, and it's good for all of us. And thank you for coming and helping to celebrate DigiFest 2014. We appreciate you.
Thanks for having us.